Hi, during the current pandemic, instead of just scrolling Instagram or something, in this time, I will share a little knowledge about accounting. And first, what accounting is. Accounting is the system of recording and summarizing business and financial transactions and analyzing, verifying, and reporting. The purpose of accounting is to accumulate and report on financial information about the performance, financial position, and cash flow of a business. This information is then used to reach decisions about how to manage the business or invest in it or lend money to it. And then, what is the function of accounting in the world? Accounting plays a vital role in running a business because it helps you track income and expenditures, ensure statutory compliance, and provide investors, management, and government with quantitative financial information which can be used in making business decisions. Not only for the business world, accounting is also important for our daily personal lives, such as budgeting for your money. Most companies hire accounting at the beginning of every business cycle to help them determine the best way for them to spend their existing assets. And number two is tracking your expense and income. And third, saving for the future. And the last, investing to make more money. From the explanation I just explained, maybe that's the picture of accounting. But wait, accounting also has an end result, namely financial reporting. Then, what is a financial reporting? Financial reporting is your main source of information to understand the financial health of your business. To achieve the highest accuracy, your financial reporting needs to have its main component. Here are four of them. And the first, income statement. The income statement is the most important component in your financial reporting. There are two subsections in the income statement. The first is the one that shows you gross profit or loss. To get this number, you can subtract the total income with the cost of goods sold. The cost of goods sold is the opening stock plus net purchase minus the closing stock. The second subsection in the income statement is the net profit or loss of your company. The amount of net profit or loss can be generated from subtracting the gross profit or loss with the operational costs such as salaries, tax, rent, and many others. And the second is balance sheet. The balance sheet is the part of financial reporting that portrays the ability of your company to honor your debt and obligation compared to the company total assets. And third, cash flow. The next component of financial reporting is cash flow. It summarizes your company inward and outward cash movement. The inflow and outflow of money can be generated from operation, investment, and financial activities. And last is change in equity. The last component of financial reporting is the change in equity. The company reports the amount and source of equity change. Any change during a certain period can be monitored from the increase or decrease of the beginning balance compared to the ending balance. And now, what different tangible asset and intangible asset? Tangible assets are typically physical assets or property owned by a company, such as equipment, building, and inventory. Tangible assets are the main type of assets that companies use to produce their product and service. Intangible assets are non-physical assets that have a monetary value since they represent potential revenue. Intangible assets include patents, copyrights, and the company brand. Okay, I've explained everything. Do you have any question? Let's see. A shareholder, also referred to as a stockholder, is a person, company, or institution that owns at least one share of a company stock, which is known as equity. Because shareholders are essentially owners in a company, they reap the benefit of business success. This reward comes in the form of increased stock valuation or as financial profit distributed as dividend. The financial report needed by shareholder is the income statement. Second question. The WorldCom scandal was a major accounting scandal that came to light in summer of 2002 at the WorldCom, UAS's second largest long-distance telephone company at the time. From 1999 to 2002, senior executive at WorldCom, led by founder and the CEO Bernard Ebers, earning in order to maintain WorldCom's stock price. The fraud was uncovered in June 2002 when the company internal audit unit, led by Vice President Cynthia Cooper, discovered over $2.8 billion of fraudulent balance sheet entries. Eventually, WorldCom was forced to admit that it had overstated its asset by over $11 billion. At the time, it was the largest accounting fraud in American history. Soon afterward, Chief Financial Officer Scott Sullivan, Cooper's immediate supervisor, called Cooper in for a meeting about audit project and asked the internal audit team to walk him through recently complete audit. When Smith's turn came, Cooper asked about his prepaid capacity entries. Sullivan claimed that it referred the costs related by sometherings and line that were either not being used at all or were seeing low usage. He claimed those costs were being capitalized because the costs associated with line leases were fixed even as revenue dropped. He planned to take a restructuring charge in the second quarter of 2002, after which WorldCom would allocate this cost between restructuring charge and expenses. He asked Cooper to postpone the capital expenditure audit until the third quarter, heightening Cooper's suspicion. Bobbitt finally called an audit committee meeting for June 2002. By this time, Cooper's team had discovered over $3 billion in questionable transfer from line cost expense account to asset from 2001 to 2002. At the meeting, Farrell stated there was nothing in GAAP that would allow those entries. Over the weekend, Cooper and her team discovered several more suspicious prepaid capacity entries. All told, the internal audit unit had discovered a total of 49 prepaid capacity entries detailing $3.8 billion in transfer spread out across of 2001 and the first quarter of 2002. Several of them were key in on explicit direction from Sullivan and Myers under the line SS entry. At an audit committee meeting that Monday, Sullivan presented a white paper explaining his reasoning. They concluded that the amounts were transferred with the sole purpose of meeting Wall Street target, and the only acceptable remedy was to restate corporate earnings for all of 2001 and the first quarter of 2002. Anderson withdrew its audit opinion for 2001, and the board demanded Sullivan and Myers' resignation. On the same day, WorldCom executive briefed the SEC, revealing that it would have to restate its earnings for the previous 5 quarters. Later that day, WorldCom publicly admitted that it had overstated its cash flow by over $3.8 billion over the previous 5 quarters. I think it's enough, maybe useful, and goodbye.